If anybody knew exactly when the stock market was going to crash, they would be a trillionaire. However, whilst time in the market does beat timing the market, all investors cannot help but try to determine directionally where we're going to go. And I've noticed a lot of is there going to be a crash videos recently and wanted to give my current take on the market. Now, this was going to be a highly technical video about macroeconomics. And what I will say is I did a video about this topic this time last year, which you can find linked in the description. And a lot of that still stands. There are a lot of leading indicators that suspiciously have pointed to a recession, and obviously a stock market crash typically precedes a recession, at least in the GDP numbers, right? And a lot of those look very off and very interesting. For example, the yield spread between the 2-year and the 10-year went negative, and we have yet to see that recessionary period come. You can see all the times that it even dipped below zero for a very short while. They coincided with the stock market having a huge correction not long after, and a recession followed. The leading economic index has been trending downwards for a very long time. So we have all of these unique forces at play. And as I said at the start of the video, if anyone can tell you, oh yeah, the stock market is going to crash or it isn't, then they're probably lying to you if they can predict that with 100% certainty. Now, what's interesting in today's market is I think that valuations are moderately extended looking at metrics. However, a lot of these metrics are distorted to a large degree. A lot of people talk about the Schiller PE and the forward PE of the entire market. But what we've had is we've had a company, Nvidia, that is actually growing. I'm not sure about the fastest rate in the S&P 500, but it's certainly growing at the fastest revenue growth rate in the Nasdaq 100 right now, despite also being the largest company. And you have this pattern where the big guys are making up a greater and greater proportion of the index, but they are the companies that are growing faster than average, let's say in revenue and profit, right? Particularly for the S&P 500, but also for the Nasdaq, that are pulling the indexes up. And at the same time, we're now in an environment where, because of the economics of AI and the revolution that's going on, because of the flywheels that you get from data, right? More customers using an AI gives it more data to train on, and you get a feedback loop where the AI gets progressively better. It's a very powerful flywheel. It also is going to mean that it's going to be a winner takes most world, and a small number of companies are going to capture a disproportionate share of the value created. Yes, some of those companies will have data and distribution advantages and be much smaller, but if you look at the dominance of the index, Nvidia, right? They design the architecture for these chips, and they distribute, and they have the software network for training and running AI models. You've got the cloud providers that are also building their own LLMs and have heavy investment in LLMs and are going to capture a huge share of that market, right? So Nvidia plus Amazon plus Alphabet plus Microsoft. And you've got Tesla, for example. They are leading the way when it comes to robotics, potentially full self-driving as well, and are exploring AI in the Internet of Things and in the real world. So you've got companies that make up huge proportions of these indexes, potentially going to benefit disproportionately from AI as well. And if you look at their valuations, they're moderately expensive, but they're also not egregious. So here we can see with Microsoft, there is some multiple expansion over time. However, the price to sales of 13.48 is slightly above where it was in the last 5 years. Microsoft had some multiple expansion from 2016 all the way up to 2020. However, the revenue growth pre-2016 was pretty slow. And this is where Microsoft had its Nadella golden period and really started to thrive again. So they had some multiple expansion and then they stagnated. And here's Alphabet. Again, similar kind of thing. After that recent rally, price to sales slightly above average where it was in the last few years. Good growth, re-accelerating growth, and a lot of excitement, particularly with their Gemini models and VO models. And that's what you've got to consider in this world. And consider the total addressable market for artificial intelligence and the way that that will change how we work. The actual power that these models are already showing. Its potential to replace hundreds of millions of dollars on movie sets or writing. And I know it's difficult. I know it's a very uncertain world. And that's the basics of this video. I was going to make a highly technical video about macroeconomics and basically saying, on the one hand, I don't think we're in a crazy AI bubble at the moment, given that I think most of the valuations of the companies that make up the Mag 7 and thus nearly half of the weightings of the Nasdaq and the S&P are not egregiously expensive. Obviously, the exception to that is Tesla, and they're expensive on a quantitative level. Again, on a qualitative level, yeah, they take 50% of full self-driving and 50% of the humanoid robot market in the next 10 years and make meaningful revenue from it. There's an argument to be made that they're not that expensive, which is the bull argument that a lot of Tesla shareholders and advocates for the company make. But that's not to say that we certainly could get a haircut in the stock market in the near future. If you look at, for example, the price to sales of MasterCard, PE of MasterCard is pretty cheap. I'm using MasterCard because it's quite a good barometer for the whole economy, and it does make up quite a big weighting, not in the Nasdaq, but in the S&P. And you can also see MasterCard's revenue growth and EPS growth have been pretty consistent as well. It's the same thing for Visa. So you've got a lot of companies where they are maybe a little touch expensive, but we're certainly not in .com territory. However, I certainly think that we could have the potential to be in .com territory with the way that everyone is talking about AI at the moment. It's also worth noting that a lot of crashes that have happened recently, they have come about on almost like a black swan event. Trump announcing tariffs to the extent that he did, or for example, COVID, that was a massive black swan. And we're in a very, very sentiment-driven market. The world is going very fast. The stock market moves very fast these days. The volatility up and down has been kind of crazy. And that's what we've got to remember as well, is that there could be another one of these events very soon that takes a big haircut off the market. Now, where does that leave us as investors? As investors, what we need to do is we need to look at the best risk reward opportunities, obviously, right? And you can take a company, for example, the Trade Desk comes to mind, where they were insanely priced for perfection for a very long time, egregiously overvalued in 2021, and hence they had about 4 years of almost trading sideways, and then when their revenue growth slowed, the stock took a huge haircut. I think they're probably 70-75% below all-time highs now. And there are a lot of companies in my portfolio that actually have very good AI tailwinds, so the future looks bright for them, potentially, but their price to sales, price to gross profit, even forward price to free cash flows are actually close to all-time lows, whilst their growth has remained pretty consistent. And obviously I talk about a lot of these companies on this channel. And I see stocks that are very expensive, again on a quantitative level, in the market right now. And those are the stocks that I don't talk about, even if they are hot stocks, right? And this is what you've got to remember, is that it's all about risk reward. You can take the market as a whole, and yes, there could be some crazy sudden macro event that could all of a sudden turn the market. And the higher the market goes, the more it can fall. What's quite interesting is we're in quite a similar period. I know I mentioned .com. In 1997, the market had a huge run up all the way from 1994. It was nearly a double in those 3 years, which is what we've had in the S&P since the bottom of 2022. And those doubles are quite rare within that time period. Now, that was also going on at a time when rates were being cut. Everybody was very optimistic about tech, and the rally went on for another few years. And my personal opinion is, I think that despite people being scared that the market has gone up a lot, the sentiment with regards to AI is very powerful. And I think that it's going to take a bit of extra rallying to change that. As I said, we could get a black swan in the meantime, or just something out of the ordinary that crashes the market like that, which is a lot of what we've been experiencing. So always remember as investors to have a good idea of what your company is worth and have a good idea about that risk reward discrepancy between the two. And if you're chasing hype, then all too quickly, when you get on rough waters, you can be scared out of a stock. And hype stocks, they tend to have a clan or quite some following. And if they don't work out, then the share price drops can be dramatic. Obviously, that's the risk you take. Anyway, I just wanted to share my thoughts on the market overall. No, I don't think we're in a bubble, as it were, although there are certain areas that are very, very bubbly. I think that if we get a black swan, it's more likely to crash the market a little bit more than in 2024. And then even more so than in 2023, where a lot of companies were extremely cheap. But it's also true that the longer a bull run goes on, the bloodier the bath could be in the future. Thank you very much for watching the video. I'll see you guys in the next one.